All right, folks, welcome to Module 2. We're going to be discussing a total of 8 different applications in which you can use MACD crossovers to help you identify setups and just get a better handle on what's going on in the market. Before we go into each of those 8 modules, I just wanted to take a few moments to go over some rudimentary material. If you're a new trader, the term MACD crossover is probably not as familiar as if you're a more experienced trader, so I just wanted to clarify the events or the phenomena that we're talking about with regards to this terminology. So the first example we're going to look at is just a very straightforward sort of textbook MACD bullish crossover. And what we're looking at here is the blue line in this little indicator panel snippet is the MACD line itself, and the dashed black line is the trigger line. The trigger line for MACD is an exponential moving average of MACD itself, so you can sort of think of it as a smoothed and averaged version of MACD, so it always lags behind MACD. Now in this example, we're not showing price because we just want to focus on the indicator panel, but you can see reading the panel from left to right, what's happening is the MACD is trending down towards the waterline below the trigger line, and the conventional interpretation of that is that that is bearish behavior. And then it penetrates the waterline, which is this horizontal line, penetrates the histogram, then reaches a sort of maximum bottom down here, sort of flattens out. You can see the slope of the line is kind of flattening out, losing that downward angle, turns the corner, and then punches up and through the trigger line. The conventional interpretation of this event is that it may represent a shift in momentum from bearish to something else. Now that something else may be bullish, or it may just be a cessation for the time being of the bearish action that brought us down here. You always have to read that in context. But the conventional interpretation is that this is a bullish event. And in very sharp reversal patterns, you will almost always see MACD punch up and through its trigger like this. As I had mentioned earlier, Module 3 is going to deal with the various situations where you can't read this completely literally. But for now, we'll just regard this as a bullish crossover, which means that the momentum may be shifting from bearish to otherwise. Now, the most important part of interpreting these crossover events is to play it smart. And by that, I mean always waiting for this first histogram bar to paint in on the opposite side of the waterline from whence MACD came. So in other words, you can see through this cycle here where MACD was coming down, the histogram bars were all painting in red below the waterline, which is almost self-evidently bearish. But you can see what happens as MACD comes up towards the trigger line, it flips to the other side of the waterline, and instead of having these bearish red bars, we now have a green bar painting in. This is an important point, more important than you might think, because what can often very easily happen is you can get misled in the live edge of trading by seeing one of these crossover events appearing to unfold. And then if you use that as ammunition to jump in on the long side of the trade, you could find that by the time that the candle, the price candle corresponding to this histogram bar, by the time you get a close, MACD has actually come back down, bounced off of this trigger line, and continued to head down, and price along with it. So it can be a bit of a head fake. So, you know, some people will tell you to jump in when you think you have a crossover unfolding. I would suggest that the more conservative, less risky approach is to wait in every situation until you have one of these histogram bars painting in on a close on the opposite side of the waterline. But there you have, in a nutshell, what a bullish MACD crossover looks like. Here then is a bearish MACD crossover, and this example is taken from the AccuCharts platform. So from left to right, MACD penetrated the waterline, cleared the histogram, continued trending up with good physical separation between it and its trigger line, which in this example is this narrower yellow line. Then it reached this quasi-overbought territory way above the waterline, did this kind of topping out process where the slope of the line flattened out, then changed direction before MACD penetrated the trigger, and that was finally confirmed by this first histogram bar painting in on a close on the opposite side of the water line. So like a bullish crossover, the bearish crossover has an interpretation, a basic interpretation, that's just the inverse of that, of course, which is to suggest that whatever bullish momentum took MACD up this high has temporarily at least changed, which doesn't necessarily mean gone down or reversed, but could very well just be price action going sideways or just retracing a little bit before continuing on up. But that, in a nutshell, is what a bearish crossover looks like, and we'll get into the various caveats and exceptions and nuances of interpretation with that in succeeding modules. In the two prior examples that we looked at of crossovers, in both cases, the event happened way distant from the waterline, either way below or way above, which can happen and often does, but it's very important that you don't make the mistake of assuming that a bearish crossover, for example, has to happen way, way above the waterline, is only valid in one sort of area of the indicator panel, or is somehow more valid the higher up from the waterline is, or conversely, a bullish crossover is somehow more valid if it happens way below the waterline. It's kind of a natural tendency to think that way, and you often do see that happening in really sharp reversal patterns. But the point we really need to address here is that crossovers can and do happen anywhere on the indicator panel relative to the waterline, and it doesn't necessarily imply anything about the quality of the crossover. And I'd like to show you a few examples to prove that. Here is a similar example to what we looked at in the first slide, a bearish crossover where MACD actually is punching through the trigger line way above the waterline in this quasi-overbought territory. So that's pretty standard. You'll see that very often. But you can also get a perfectly legitimate bearish crossover happening right on the waterline, and you can also get a perfectly legitimate bearish crossover happening actually below the waterline. This is important to keep in mind because a lot of people will tell you that kind of anything above the waterline is overbought and anything below the waterline is oversold. So if you were getting a bearish crossover in oversold territory, isn't that kind of dangerous, or isn't that somehow invalid? And the answer is not necessarily. It all depends on the context. It all depends on the other aspects of the setup that you're looking at, price action itself, other indicators. For example, this kind of anemic-looking crossover here, where we're already below the waterline, this is kind of referred to as, or we're going to refer to it as, a continuation crossover. And you can see this happen over and over again when you've had a big substantial move down in price. Price then goes sideways. MACD looks like it's going to head up and possibly even penetrate the waterline, but it doesn't, and instead it punches back down and through in this already quasi-oversold territory. But that can be a perfectly legitimate signal of a really healthy down move, and we'll see examples of that later on as well. Now, if you wanted to sort of see this principle in action with regards to bullish crossovers, well, really all you have to do is flip each of these three pictures upside down, and it would be said that the same principle. You can get a bullish crossover happening way below the waterline, on the waterline, or above the waterline, a continuation crossover to the upside. So it's the same principle, just inverting these different pictures. So don't read too much into a crossover happening way up here and assuming that's the only kind you can work with. That's not actually the case. Just going to take that concept a little bit further and prove, not only with some indicator examples, but also some price action, that point of not reading too much into crossover action depending where it's happening. So, for example, if you were to read the MACD crossover happening in this particular example as not particularly thrilling, or not a high quality crossover, or a weak crossover because it's just so shallow and anemic looking relative to the waterline, it's not happening way, way below, you would be in danger of missing out on a really great move. What this shows is that it's not so much where the crossover happens or how dramatic looking it is, but just the fact that you get a crossover at all, MACD through its trigger line. In this case, it was very shallow, right on the water line. But look what a wonderful rise in price that this event foretold. Similarly, it can be dangerous to read too much into what looks like a strong crossover. Here you have MACD way up in the stratosphere in this overbought territory, punching sharply through its trigger line. And if you were reading too much into what it looked like, you would conclude that this was a very good bearish signal. But as we can see here by price action, what actually happened is price more or less chopped around sideways, kind of went into a trend channel with a bit of an upslope. And if you had used this crossover event as a signal to go short, it's a pretty good chance, depending on what time frame this chart represented, that you would have been taken out of your trade. If this was a daily chart, you would most likely have been taken out of your trade and gotten stopped out. So this again just demonstrates that you can't read too much into the visual qualities of a crossover. It has to be read in context, and it's the crossover itself with the histogram flipping to the other side that's really the determinant, not sort of where on the panel it happens. The first application we've identified for MACD crossovers is to help us anticipate crossovers on moving averages applied to price itself. For years, the two moving average concept has been a very popular one, and the idea being that when a fast moving average crosses over a slow moving average, there's a rate of change or momentum shift aspect indicated by that, although the number one criticism of moving averages is that they're lagging indicators, and therefore crossover events are going to often be behind the action. Regardless, some of the more popular two moving average configurations that are out there, 50 over 200, 89 over 144, those are both members of the Fibonacci sequence. 10 over 40 on low-level time frames to help yield entry signals on a 5-minute chart, say, and then the increasingly popular Guppy multiple moving average. And even though that concept is comprised of 10 or 12 individual lines, they really do function like a two moving average system. It's just that instead of one slow moving average, you have a group of slow moving averages, and instead of one fast moving average, you have a group of them. But we're going to provide some chart examples that make use of Guppy multiple moving averages in conjunction with MACD, which can be really cool in a trending market. So moving average crossovers are important because they provide additional confirming signals of a breakout or protracted rally of some kind, and therefore they can help us time an entry. More likely a second or third or fourth position rather than an initial entry, because it's often so late, and you can run the risk of getting in late on the move. Now, I mentioned that the number one criticism of moving averages is that they are lagging indicators, and therefore crossover events tend to be really late. So one of the beautiful aspects of MACD crossovers is that they remove a lot of that lag. They're more predictive ahead of the action. But the flip side of that is you really have to make sure that you're not getting in too early. Sometimes you can get a MACD crossover triggering too early, and so it's very important to consider the context that you see them in. But we're going to look now at an example of how MACD crossovers can help us anticipate moving average crossovers and how the two systems can work side by side. Alright, here we have a price panel with the Guppy multiple moving average system plotted, and the group of blue lines are the slow lines, which comprise a 30, 35, 40, 50, and 60 period EMAs each, and then the group of orange lines are the fast lines, comprising the 3, 5, 7, 10, and 15 EMAs. And just the same way that you would read two moving averages or MACD relative to its trigger, anytime the fast group remains above the slow group with good angle and separation, that's inherently bullish, and vice versa. If the fast group was below the slow group trending down with good physical separation, that would be a bearish trend indication. So what we're going to do here is just look at how the MACD crossover anticipates a moving average crossover. In this case, what we're looking at is for the group of orange lines to punch up and through the group of blue lines and then continued trending on up from there. But the price action that actually triggered this whole thing was fairly robust enough that the events actually came pretty close together. So let's start at the very bottom here. This is an 8-24-9 period MACD setting, and we had a bullish crossover event, again confirmed by a histogram bar painting in on the opposite side of the water line, and that happened just a few bars, well actually more than meets the eye actually, probably 1, 2, 3, 4, 5, 6, at least a half dozen, more like about 10 bars ahead of this bullish crossover, the fast group of lines crossing over the slow group. So it gave you a good anticipation of this crossover unfolding, and of course in the background you had another very important signal, which was this very distinct hammer floating around by my cursor right there, which marked an end to this short-lived down move here. So we're not going to be able to get as much into specific trading strategies in Module 2 here, because we're just trying to address some fairly rudimentary topics. And in all cases, as you're going to see, the trading strategies inevitably result or involve rather a multiple time frame top-down approach. So I just want to steam through some of this introductory stuff first without looking at too many charts for each example. But in a nutshell, if this was an intraday chart, a fairly low-level one, such as a 15-minute, 30, or a 60-minute, one way you could approach this is to first wait for MACD to issue the crossover, and then, in this case, price kind of went frothy or sideways on us. But once you were up in this area here where my cursor is, you could have just more or less either got down to a real low-level chart like a 5-minute and wait for a confirming signal to go long, or you could have just basically jumped in anywhere if you were dealing with a fairly constricted price range here, and then just place your stop below this swing low here, and as you can see, it would have been well protected. Price didn't really come back down and test this slow group of multiple averages, moving averages too hard, poked down just a little bit over here, but your stop placed down below this small little wick would have been protected. So you could have more or less just jumped in anywhere if this was an intraday chart and we were only talking a range of about 20 or 30 pips here. That would have been perfectly fine. Now, what you'll see happening is this is really neat actually, to read MACD in conjunction with a good moving average system. Yeah, moving averages always predict the past, not the future. But if you're in a protracted trending situation, you can read these moving averages against MACD crossovers. We have another one happening all the way up here, which looks like a bearish crossover, but you can see there's absolutely no sign of price turning the corner. First of all, we don't have any kind of a top, well, we have a spinning top, but not what I would call a super clear chart reversal pattern up here. Price did not penetrate the slow group of moving averages. The orange lines did not even touch the blue lines, and so we were able to read this bearish looking crossover as nothing more than just a short-lived fake out signal. We're going to go into fake outs in much greater detail in Module 3. But just as a quick example, this shows how a bullish MACD crossover did a good job of anticipating a moving average crossover.